Hello, today I want to talk about implied volatility. Now, everybody knows the big brother, the big daddy in terms of implied volatility is the VIX, the implied volatility on the S&P 500. I do have some videos on that topic. You can watch those videos by following these links right here. Right now, it kind of seems like we're in a volatility summer holiday. Volatility is relatively low. I also want to think about here today some alternative measures. You have some non-S&P 500 implied volatility measures for implied volatility. I want to think about what we might see going forward. We're going to see lower volatility than we're already seeing now, or might we see some spikes at some point in time? Here in this chart, what I have is a chart of the VIX, the actual implied volatility of the S&P 500, starting from the peak, the pandemic peak, March 16th, 2020 of 82.69. Now, the volatility itself is a little volatile here, but we do in general see a nice downward trend. We're now comfortably sitting below 20 in the implied volatility of the S&P 500. Now, if you were to go to the Federal Reserve of St. Louis, you would find some other measures of implied volatility. And that's what I've done here. So I have the S&P 500 implied volatility in blue, but I also threw in here the Nasdaq 100 implied volatility and the Russell 2000 implied volatility. Now, they are highly correlated here, but they're not the same, right? So what I did is I wanted to see how often is one particular measure the highest of the three. And what I found is that 28 basis points of the time, the S&P 500 has the highest implied volatility. 14.45% of the time, the Nasdaq 100 has the highest implied volatility, and 85.27% of the time, the Russell 2000 has had the highest implied volatility. This makes some sense. We would expect small cap stocks to be riskier than large cap stocks. Here, what I'm doing is I'm going back 5 years. I think it's interesting to note, if we look at this period pre-pandemic, we had an average implied volatility on the VIX of 14.31. Now, if we compare that to the post-pandemic drop in volatility, what we see here is the lowest of the low in that period is 15.07%. So that would imply to me that we have some more room to go in terms of the volatility declining a little bit. Again, what I want to do is think about which one of these has the highest number in this time period, where I found that 72 basis points of the time, the S&P 500 has the highest implied volatility, a little bit higher than from that shorter period we just saw. 44.3% of the time, the Nasdaq has the higher volatility, and 54.98% of the time, the Russell 2000 had the implied volatility, a little still the number one benchmark, but much more balanced than we saw in that shorter period there. Now, what I want to do is I want to go back all the way to 2004. I'm using this period because this is when the daily numbers start in terms of looking at the Fed numbers. And what I want to point out here is, yes, we saw this global financial crisis. We saw a big peak in terms of the implied volatility on the VIX of 80.86, and then we saw a decline there, but we also saw these aftershocks here, which is kind of interesting. So if you go look here at 2010, 2011, you see these aftershocks in the 40s on the VIX. So that makes me wonder, hey, what are we going to see, going forward? So I'm going to argue that maybe we're going to see, yes, we're going to see VIX trend lower, but we're going to have a couple of blips there where we see kind of an aftershock from the spike that we saw during the peak of the pandemic. Finally, to go back here and it's like, look at the percentages in terms of which one of these has the higher implied volatility. S&P 500, again, back down, really low number, 23 basis points. The Nasdaq 100, 19.64%, and kind of leading the charge here, 80.14% of the time. The Russell 2000 has the higher implied volatility, kind of reversing the reversal that we saw over the last 5 years, again, implying that, yes, this makes sense. The smaller cap benchmark should have higher volatility. Therefore, it should have higher implied volatility. Hope you enjoyed that. That is it for today. Please hit subscribe, hit like. It really does matter. Happy trading out there. I'm Brian Kozlowski. Thank you so much.